midway through the trading week, and Peter Kinsella, currency strategist at Commerzbank London, joins me on the phone now to discuss his currency forecasts for the major currency pairs. Firstly, Peter, we've seen this week already the Troika's planned visit to Greece on Monday has been delayed until July, and there's been a spread of data come out from the UK and the Eurozone. Talk me through how the markets have responded this week, particularly in the lead-up to the European Union summit taking place on Thursday and Friday.
Thus far, the markets haven't done an awful lot, frankly speaking. Euro-dollar's come off a little bit in expectation of the summit later on this week. Economic data, broadly speaking, has quite underperformed. If you look at sort of AMI data from the UK, from the Eurozone, Italian retail sales are very, very poor on a year-on-year basis. So economic data has definitely been poor. In terms of general risk sentiment, that also has been poor. You've seen an underperformance of certain risk assets. Elsewhere, the yen has weakened a little bit, which is normally, associated with good data, but broadly speaking, I would say that we've seen an underperformance of certainly the euro.
So if we take a look at our first pair, the pound US dollar, the pound slipped lower against the dollar as investor confidence was hit by concerns that the EU summit will make little progress in tackling the region's debt crisis. Bank of England Governor Mervyn King said on Tuesday that the outlook for the UK economy had deteriorated in recent weeks as a result of the ongoing struggles. With suggestions that the UK debt level is unlikely to drop below £1 trillion anytime soon, can the UK really afford for there to be further stagnation in resolving the debt crisis? Talk me through your predictions for this pair.
I guess there's two things really. It's pretty clear if you've been looking at UK economic data that has been poor, particularly in the last 2 months. What you saw was that manufacturing PMI last month was pretty much hit the lowest level in the last 3 years. So you've seen a broad underperformance, both of retail sales and indeed of sort of more forward-looking indicators such as PMI, etc. So what this is really telling you is that it's quite likely that the Bank of England and the MPC are going to engage in further quantitative easing, even possibly at the July meeting. Most estimates at the moment range between 50 and 75 billion pounds of further easing. In my view, I think they're going to do roughly 50 billion pounds. So what does this mean? If you look at cable and sterling against the dollar, what you've seen is a little bit of an underperformance where we went from 158 to current levels around 156. Given that the Fed last week merely extended the Operation Twist rather than going for an outright kind of QE3 program, this to my mind says two things. It says, first of all, that we're going to see a slightly stronger dollar because further QE3 would have hurt the dollar a little bit more. So I think it's more likely that we're going to see certainly a little bit more downside in cable in the coming weeks and months. So I think even on a 1 month basis, we see 1 or 2 month basis, we'll see cable towards 155, even 154. And towards the end of the year, really, it's more contingent about what happens with the euro-dollar exchange rate. But by and large, we think it's more likely than not that we'll see a certain underperformance of cable.
The euro-Japanese yen is another pair which has fallen on fears over this week's summit. As sentiment in Europe declines with soaring borrowing costs across the region and concern over Spanish bond yields, can we now anticipate a balancing act between the euro's decline and yen gain as investors flock to it as a safe haven? What are your forecasts?
The problem here really is that you're dealing with two currencies that are both fundamentally weak, albeit for different reasons. If you look at the yen has been very, very, when I say weak in sense of fundamentals, but the yen itself is quite strong. However, the yen is too strong for the Japanese economy. The way you can see this is that if you look at even Japanese exporting companies, they're having lots and lots of troubles actually making money. Okay, the strength of the yen is proving to be a pretty significant burden for exporters. The way we saw that earlier on this year was when the Bank of Japan came out and said that they were going to have an interim inflation target, right? Whereas before they didn't. So in essence, they were quite happy to print money in order to get this to achieve this inflation target of 1%. However, if you look at 10-year break-evens in Japan, they're only showing about 0.5%. So it seems that the BOJ were going to have to do a little bit more money printing in order for those break-even inflation rates to hit 1%. Okay, so there are pretty substantial reasons, or strong reasons, for why we should see a weaker yen. However, at the same time, if you look at both the economic crisis in the eurozone and then the actual structural crisis in the eurozone, the question is which is worse. Within the Eurozone, first of all, economic data has been very poor. If you look at Italian retail sales, yesterday they came out -6 and -7% on a year-on-year basis. Likewise, unemployment data is getting worse. It's not getting better, both in Spain and in Italy. The real worry here isn't just that Spain or Italy are forced out of the markets. I mean, frankly speaking, if Spain has to issue money at 6.6% for 10-year paper, this is a de facto, let's say, they're de facto already sort of being excluded from the markets at these levels. it's only really a matter of time before the focus shifts increasingly on Italy and then even potentially on France in the coming weeks and months. So realistically speaking, for us, we think that euro-yen at this point will be largely range-bound. I mean, at the moment we're trading 99. I think we're going to get up to around 100, 101 within a month or two, and then even possibly 103 by year-end. So broadly speaking, we see that the risks are somewhat more in favour of further yen weakness. But again, this is contingent upon events in the Eurozone not really spiralling out of control.
The Euro-Swiss franc is a pair that has seen little change over the last few weeks, despite the turmoil going on around it. As expected, the SNB have continued to defend the 120 level. Do you anticipate any changes here over the short, mid and long-term period?
As you said, it's been unchanged for the last number of months, and I think it's going to be unchanged for the next few months, if not years, the way things are going. There's 2 points to make. First off, the central bank came out last September and said quite strongly and quite specifically, we're going to defend the 120 level at all costs. And that is precisely what they've done. If you look at their latest accounts, it seems that they've been intervening again in order to support this peg or this lower bound. At the moment, it's not really an issue for the SNB because this increase of the monetary base thus far has not increased inflation in Switzerland. In actual fact, they have a small problem with deflation. So the 120 lower bound is definitely not a problem for the SNB at the moment. Should we see much higher or significantly higher levels of inflation, then it would be an issue. The bigger issue really for the SNB is actually regarding their exit strategy, okay, within the next year or the year or two. How are they going to extricate themselves from the situation? It's at that point, probably in a year or even maybe 2 years from now, when the crisis subsides, it's at that point then that they're going to have a rather tricky balancing act to perform.
Peter Kinsella there from Commerzbank, offering us his insight into the global currency markets. Stay tuned to Dukascopy TV for more exclusive interviews. For now though, goodbye.